Chapter 11. Greed and Fear. Wealth isn't primarily determined by investment performance, but by investor behavior. Nick Murray. Greed and fear are critical emotions to understand. These emotions are the basis of every human action. Whatever anybody does or does not do is based on either greed or fear. These emotions are good, certainly not evil. In the investment world, greed and fear are the lifeblood. Without these, there would be no economy, no capital market, and no transaction. Greed and fear are the best friends of a prudent investor when these are subordinate to analytical skills. However, when these emotions overrule the analytical skills of an investor, they become the worst enemies. Emotions are like fire. They are valuable and beneficial if an investor understands them and knows how to keep emotions in check. If you let these emotions go wild, then you burn your investment career badly, if not fatally. One emotionally driven investment that causes massive losses is enough to keep you away from all investments for life. Invest for the long haul. Don't get too greedy and don't get too scared. Shelby M.C. Davis. All investors are both greedy and fearful all the time. There is no bright line between these emotions that can be crossed. You cannot point out a specific time when you were only greedy and not fearful at all. It does not happen. Let me explain this with a few examples. Suppose your stock has risen a lot and you sold 20% of your long position. What was your emotional condition? Were you only greedy when you were holding your 100% up to the point of sale? Were you only fearful when you were pressing the button to sell your 20%? Are you only greedy again after the sale? The answer to all these questions is no. You were and continue to be both fearful and greedy all the time. Another example is when an investor sells his stocks in a downturn in the hope of repurchasing them even lower. Is he greedy or fearful? The answer is both. How about a concentrated position that is keeping you awake at night? You know that you can lose a substantial portion of your capital, but the possibility of a huge profit forcing you not to sell. Are you greedy or fearful? A famous quote from Warren Buffett is, "Be fearful when others are greedy. Be greedy when others are fearful." If everybody is both fearful and greedy all the time, what does he mean? How can you be greedy if everybody else is both greedy and fearful? If everybody is both greedy and fearful all the time, there will be no transaction. The market will freeze. One emotion has to dominate the other to buy or sell. The only window we have about the participant's emotional state is transaction volume and price action. But we know that every transaction is between two parties. The buyer has to be greedy enough to make the purchase, and the seller has to be fearful sufficient to execute the sale. People who are making the transactions are a handful compared to all market participants who are not participating and watching from the sideline at the moment. Their emotional state is not known and does not matter. So the paradox is, how can we say which emotion is dominating if everybody is greedy and fearful at the same time, and half of the people who are making the transactions are greedy, and the other half are fearful? To solve this paradox, let's analyze the transaction process. A transaction process is started with two quotes. The bid, the maximum price that a buyer is willing to pay for an asset, and the ask, the minimum price a seller is willing to accept. The difference between these two prices is called the spread. A transaction can only occur when either of the two parties agrees to the price of the other. When most buyers agree on the seller's demand, prices rise because the seller's price is always higher. When the majority of sellers agree to the price quoted by buyers, prices start dropping. It is all about who is losing the negotiation battle. Who is more willing to give and accept the price of the counterparty? When a buyer thinks that if he doesn't agree on the seller's price, somebody else will, and he will have to agree on the next seller's price, which may not be as attractive as this one. In this case, he gives his ground and agrees to the seller's price, and a transaction occurs. When a transaction happens, a new buyer and a new seller start negotiating. This new seller's ask price is even higher than the previous seller's, and the new buyer's price is lower than the last buyer's. Spread widens between the prices. At this point, somebody has to adjust the quote to keep the spread on a routine width, and then the process starts all over again. When transaction volume goes to the roof, the spread widens dramatically. In the real world, all of this process happens in a fraction of microseconds. Computers of market makers are keeping bid-ask quotes and spreads in check. Millions of transactions happen every second. It is not humanly possible to see all of it in real time, other than in the case of very low volume stocks. Greed in investing and trading. The person who starts simply with the idea of getting rich won't succeed. You must have a larger ambition. John D. Rockefeller. Investors need to understand their emotions and keep them in check. The sole purpose of investing is to convert your existing pile of capital into a larger pile. However, an investor must know when his desire to make large profits takes over his ability to analyze an investment opportunity objectively. There are 4 factors that create irrational market behavior: overconfidence, biased judgments, herd mentality, and loss aversion. Burton G. Malkiel. An investor must not engage in excessive risk-taking, where large profits can be earned at the expense of total capital loss. The lottery is always a good example, where the chance of winning is extremely low, but a small risk can be converted into a large sum of money. It is a binary outcome. Either you lose your investment or you win a significant amount. Investments are not a lottery. If it feels like the lottery, stay away from it. When you start bending your own risk management rule, you should know greed is creeping in. If your rule is not to invest more than 5% in one industry and take a 6% position, you are becoming a victim of your own emotions. It doesn't matter if your decision earns you a larger profit in the end. It is the worst outcome because you will be more willing to bend the rules and be more inclined to take even higher positions. Why do we suffer greed? Every human suffers from greed. It is in our DNA. We want to look better, better than our peers. We want to be an alpha. This desire to be better is stemming from our biological being. It is an animal instinct. A larger animal has a better chance of reproducing and finding food. It attracts more companions. In a herd, everybody follows the best among them. Psychologically speaking, we are trained to strive for the best. We all consider ourselves an above-average person. However, it is mathematically impossible for the majority of people to be above average. We all assume that bad things will not happen to us, although there is an absolute certainty that it will happen to some people every single day. For example, thousands die in traffic accidents every day, but we still come out and drive, because we assume that if we are careful, accidents will not happen. We don't realize that everybody who was driving was cautious in their mind. We also assume that good things will or may happen to us. Even the possibilities are remote. Somehow, we believe that we have a better chance of winning a game of probabilities, totally disregarding that everybody who is playing the game has the same possibility of winning. The combination of our natural desire to be better than our peers, our faulty assumption of dodging risk, and our flawed belief of having better chances than others pushes us into excessive greed territory. We take more significant and sometimes fatal risks. How much greed is good? Never test the depth of the river with both of your feet. Warren Buffett. A healthy amount of greed is a necessity for an investor. There will be no investment if all potential investors have zero greed. We need to have a desire to be better than our peers. We need to take some risks, and we need to assume that capital investments may turn into a profit. The decision to invest is a direct consequence of our desire to grow our capital. However, once the decision to invest the money has been made, all future decisions of when to invest and what asset class to buy must be derived from the risk analysis. I mean that the risk analysis must be sitting right in between your desire to make money and your specific investment decision, like the timing of the purchase, choice of the asset class, etc. For example, your investment plan states that you want to invest 3% of your total capital in an online retail store. It also says that you will only invest after a 10% pullback or at a maximum PE multiple. You see a massive run of the online retail industry and want to invest more. However, if you buy more, you will break your investment rules. In this case, you need to go back to the drawing board. Analyze your whole portfolio. Do a risk and reward analysis. Make sure that emotions are not driving you, and then decide to invest. Don't just pull the trigger because you feel like it. How to know when your greed is becoming a problem. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Paul Samuelson. It is a misconception that if somebody is regularly losing, he must be being greedy. Your greed can be a problem even if you are regularly winning. The outcome of investments is not the criteria. You are the best judge of your emotions. Nobody else can tell you whether you are greedy or not. If you bend the rules regularly or take larger positions than you should, perhaps you are a victim of your own emotions. If you are frequently making impulse purchases, then it is a problem. The worst is when somebody does not have an investment plan whatsoever. It means the desire to make lots of money, instead of a risk framework, drives specific investment decisions. No decision is going through the filters of risk management rules. If this is the case, then it is an investor who is being played by their own emotions. A huge problem. Investing without a clear understanding of associated risk is like a child is playing with fire. Risk assets are called risk assets for a reason. Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. Joel Greenblatt. How to know the majority of market participants are excessively greedy. Markets get overheated or go into bubble territory from time to time. People get caught in the hype. The easiest way to know is to compare standard value metrics, like price to earnings, price to sales, price to cash flows with historical means. If these metrics are indicating that prices are inflated, generally that's the case. In the case of a stock or one asset, these metrics can go wrong, but for an overall market, these metrics are dead on all the time. During a bubble, you will find a lot of new metrics invented to justify the trend. For example, visitors to a website or an increase in internet users were used as justifiers during the dot-com bubble. It is better to stick with time-tested metrics and ignore all of those justifiers. Fear in investing and trading. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections that has been lost in corrections themselves. Peter Lynch. Fear is the other side of the emotion coin that keeps flipping in investors' minds. As we know, fear coexists with greed. The actions or non-actions of an investor stems from the fear of losing money. Understanding fear as an emotional trait is essential for an investor. No investor can have a successful career without a sufficient understanding of fear and keeping it in check. Generally, an investor suffers two types of fears. 1. Fear of missing out, commonly known as FOMO. 2. Fear of losing. Fear of missing out is so embedded in human cultures that phrases like opportunity never knocks at a door twice can be found in every language. Missed opportunities are way more painful than losses. Investors like to think and talk about fantasy investments all the time. For example, we could have bought Amazon in 2003. Fear of missing out single-handedly caused every single investment bubble in human history. No other emotion is more powerful than FOMO. Fear of losing is the second most destructive emotion that investors need to be aware of. The fear of loss or failure keeps investors from grabbing excellent opportunities and investment ideas within their investment plan and risk tolerance. An investor always suffers from the fear of losing. When the market goes up, we suffer from fear of losing our gains, and when the market goes down, we suffer from fear of losing our capital. It is a perpetual battle that an investor needs to fight on his own. Why do we suffer fear? The primary source of fear originates from our biological being. It is the instinct of survival that stops us from being in uncomfortable situations. Investing is an awkward endeavor. Prices fluctuate every second. The market goes up and the market goes down. it is not easy to hang on. Our animal part of the brain constantly pushes us to come out of any uncomfortable situation, or not to enter into it in the first place. The secondary source of fear is psychological. We are all trained to be right in schools and at home. We are instructed not to lose money. We are trained not to be wrong. We are taught not to be a failure. We are hardwired to try for success only. However, investing is a business, and in any business, there are good days and there are bad days. When we invest in tradable securities like stocks, then buying and selling a business is a click of a button away. If you have a farm and you have a bad year, nobody quotes your farm 50% below its actual intrinsic value. But in stocks, this does happen and happens very often. A lot of investors think that market quotes are actual losses. Let me tell you a secret. If you buy a stock above its intrinsic value, you've already made a loss at the exact moment when you purchased it. If you are lucky, you will find a bigger idiot and will be able to transfer your loss to the next person. The outcome of an investment does not make it right or wrong. It is a different story if you make an error in calculating intrinsic value. It is an expensive mistake. But not calculating intrinsic value and still proceeding to buy an asset is a stupid investment decision, if it can even be qualified as an investment decision and not a gambling adventure. The third source of fear is the fabric of society. The majority of retail investors with considerable capital are middle-aged men with a successful career in some other profession. The only result acceptable to them is success. Every decision needs to be right, if not perfect. Failure is not an option and is a mark on their successful careers and manhood. Losing trades makes them angry and aggressive, an ideal blend of destructive emotions for investors. How much fear is healthy? A healthy amount of fear is a necessity for your success in an investment career. You need to embrace different sorts of risks that are part and parcel of an investment. You need to identify, manage, and minimize these. Fear of losing money or missing opportunities compels you to do your homework before entering into a position. It also forces you to keep analyzing ever-changing economic and market conditions. As long as fear is not frequently precluding you from entering into a feasible position or not compelling you to come out from an investment prematurely, your fear is healthy. When to know fear is becoming a problem. When you repeatedly hesitate to buy an asset despite it being in your investment plan and within your risk parameters, you probably have developed too much fear. Likewise, if you are doing a lot of impulse selling and losing or leaving a lot of money on the table, you may suffer from excessive fear. Let me give you an example. You were waiting for a stock to come down to your acceptable price level, and when it did, you pulled the trigger and bought it. The share started to rise as you expected, but suddenly, the whole market went down from political news. This news had nothing to do with your stock directly, but the share went down to the level where you bought it. You got scared and sold the stock on break even. I have a question. Why did you sell? Didn't you buy at this level in the first place? Yes, it can go down, but it could have gone down the first time as well. Why did you buy it in the first place? You did precisely the opposite action at the same price level and in the same price action. Both times the price was going down. Nothing was different. If the news is directly related to your stock and changes the fundamental reasons for your purchase, it is a different story. However, you are not alone. I have done it many times. We do it because we have seen real profit during the holding period, and we have an internal fear of turning our profit into a loss. That's why break-even seems to be a valid option. For the same reason, selling on break-even happens very frequently when the stock goes down initially and then returns to the level at which we bought it. An investment business has certain risks, and your job as an investor is not to eliminate all risks, but to manage and minimize them. A lot of inherent risks are totally out of your control. For example, if you invest in a foreign security, you are exposed to a foreign exchange risk. Foreign exchange rates are dependent upon thousands of moving variables, and none of them are in your control. You can choose to hedge the risk in different ways, either partially or entirely, but it will cost you money. Similarly, stocks have a price risk. Market fluctuations are out of your control. You can buy protections like put options, but again, it will cost you money. Bonds have interest rate risks. The longer the duration, the higher the risk. You can choose to buy only short-term bonds or variable rate bonds, but you will have to accept a lower yield in general. As an investor, you will have to take risks. Even so-called risk-free government bonds have a bunch of risks like inflation and interest rate. Don't be fearful of risks. Understand them and manage and minimize them to an acceptable level. How to know when the majority of market participants are fearful. Every so often, investors panic and sell everything they have. Momentum crowds join in, and then speculators come. Before you know it, the market is down 30, 40, or 50%, or even more. The easiest way to tell whether the market is extremely cheap is to look at time-tested valuation metrics. My favorite is the P/E ratio. The June 1949 P/E ratio of the S&P 500 was 5.91. In September 1974, it was 6.97, and in March 1980, it was 6.68, just to name a few. These once-in-a-lifetime opportunities occurred multiple times in a lifetime, and will happen time and again in coming decades. You don't need to wait for a below 6 P/E to know that the market has excessively dropped. When you see that the current P/E is significantly lower than the historical average, it is time to take action. How to avoid being driven by your emotions. Investors need to keep their emotions in check for a successful investment career. It is the most important requirement. It's even more critical than having access to capital and markets. Let's discuss some of the ways we can keep our emotions in control. Acquire a knowledge base of capital investments. An investment in knowledge pays the best interest. Benjamin Franklin. An investor needs to have basic knowledge of financial assets, associated risks, market participants, market enablers, accounting, borrowing, leveraging, etc. No one is born with that knowledge. Everybody has to acquire it in one way or the other. If you are in the business of risking your capital for potential profit, then it is in your best interest to know about the business language, norms, and how everything works. You need to understand who market participants are and how they make money. You need to understand who your competitors are. Be a perpetual learner. Acquiring knowledge is not a one-time exercise. It is not like learning how to ride a bike or roller skating. It is a lifelong process. You need to be a perpetual learner. It is an old saying, the more you learn, the more you earn, and it cannot be more true for any other business than investing. If you are in this business, keep an hour or two every day to read. Don't read only about investment strategies. Read everything of your interest. You will find a couple of lessons in every book that may guide you for the rest of your investment career. Have realistic goals. Having realistic goals for your investment business is one of the most critical factors leading you to long-term sustainable success. You don't need to double your money every couple of months. An investor can have a very successful, even an extraordinary investing career with a rate of return slightly higher than the market. Warren Buffett has a 20% annual rate of return, and Peter Lynch, who is one of the legendary fund managers, has about 30% yearly return. Being realistic is not about being ordinary or being below average. It is about being honest with investment potentials. Let me give you an example. Suppose you have a business of selling t-shirts. Every once in a while, you may have a customer who needs a t-shirt at any price. If you are unrealistic and your first sale happened to be to that customer, you will be waiting for the next sale for a very long time. Between sales, you will be burning a lot of cash in expenses. You will be better off selling a lot more at a reasonable profit. Investing is like any other business. You will be better off accumulating wealth with a reasonable rate of return on your capital than hitting a home run every once in a while, and between two home runs having a lot of strikes. Know the intrinsic value of a potential investment. An investor must know the intrinsic value of the potential investment before any capital is allocated. If you think that the intrinsic value is significantly higher than the price you are paying, then proceed with the purchase. As Benjamin Graham advised in his legendary book, The Intelligent Investor, have a margin of safety between the price and intrinsic value. If your plan is to sell your holdings to another person at a higher price, then it is not an investment. It is gambling on finding a bigger idiot. What if the biggest idiot that can be found is you? Write down all relevant risks. There is no such thing as no risk. There's only this choice of what to risk and when to risk it. Nick Murray. Risk is an integral part of any investment. You cannot avoid the risk, and it is not important to eliminate all possible risks before you proceed to endeavor into the capital markets. What is important is to know how to identify, manage, and minimize the associated risks. No investment is without risks, and no opportunity is guaranteed. Nothing is certain, and if somebody claims it, stay away from that person. It is important to write down all of the associated risks you can think of: general market risks, class-specific risks, and risks specific to the asset you are buying. Remember that a price drop is not an actual risk. The actual risk is not to know the reason why the price was dropped. Have a plan. Investing is a business, and every business starts with a business plan. Can you imagine starting any other company without a business plan? However, millions of investors engage their capital in investing every year without even understanding that they need to have a plan. If you want that one day your business may provide you all means of life and beyond, then treat it like this. You need to have a plan, not specific investment ideas. This plan should include details of the current capital, your expected rate of return, possible classes of assets, risk tolerance, management of different risks, and any other general details that you think are important. This basic plan should govern specific investment ideas. All opportunities must be questioned and filtered through your investment plan. The best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. Benjamin Graham. Invest according to the plan. Once you have a plan, always invest within the boundaries and parameters of your plan. Never bend your rules to accommodate your guts. It is not a good idea for a long-term investor. Bending your rules is a disastrous habit. Stay within your boundaries. There is no investment opportunity big enough to risk the very existence of your capital and investment career. You will find countless other options within your plan parameters. You must know as a rule that no investment is a once-in-a-lifetime opportunity. Investing is a marathon, not a sprint. Every wise investor will tell you that investment is all about building wealth with a reasonable rate of return. Play this game for a long haul. I started my stock investing account with an amount equal to 5% of my wealth at the time. I promised myself that if I'm going to lose this money, I will lose it in 30 years. The first year was a loss-making year. The second and third were break-even, and it was the fourth year when I saw consistent profit. Does that not happen in any other business? You start with a small amount, you make some losses, and then you get better over time. That's how every business works, and that's how investing works. Sure, you will find a few exceptions, but those are exceptions, not the rule. I am not a good options trader, and considering my risk avoidance personality, I never will be. However, I wanted to get my hands dirty, so I allocated 2% of my account to test out options. I remember I read over 20 books on options before I took my first trade. I blew most of the allocated balance in the first 2 trades. Fortunately, I got some future transactions worked in my way and still have some of the amount left. I still buy options here and there, but have never made any considerable profit. I never sold the options because the potential risk was always outside of my tiny allocated balance. Similarly, I have never bought or sold any futures for the same reasons. Futures are extremely leveraged, and potential risk is well beyond any risk tolerance limits of my plan. To be a successful investor, you don't need to take excessive risks and be involved in all sorts of financial instruments. You need to understand your risk appetite and understand a few asset classes well. Stay within your boundaries, and your wealth will grow at a decent pace. Investing is like planting an apple tree. First, you need to pick the best possible cultivar as per your local climate. Once you plant the tree, there will be hardly any difference from one day to the next, but you will have a thriving fruit tree in a few years. There will be seasons. In summer, your tree will be happy and growing, and in winter, it will look like a dead piece of wood. There will be years when you will be able to harvest a boatload of apples, and there will be years when there will be hardly any apples to harvest. If you are a seasoned grower, you know that nothing is wrong with the tree. It is just the cycle. You don't cut the tree in winter or in bad years. You wait for it to bear fruits again. If your tree is diseased and beyond any hope, then you want to cut it down and start all over again. Sooner is better. However, to know whether the tree is healthy or diseased, you need to have a good understanding of apple trees, their different cultivars, the natural habits of your particular cultivar, and possible diseases that can affect the tree. Without this knowledge, you will cut down a healthy tree or hope for a diseased tree to bear fruit. Chapter takeaways. Greed and fear are both good and healthy for an investor and capital markets as a whole. Emotions are like fire, beneficial if controlled, destructive if wild. Greed and fear are in our DNA. We can't get rid of them, but we can learn how to keep them in check. Acquiring knowledge is the best defense against our emotions. Be realistic about potential market returns and be aware of possible risks. Have a plan, in writing.